Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Applied Digital.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So we have a really fascinating setup today. It's early 2026, and the market is finally starting to shift its gaze. For the last couple of years, it's been all about the chips, NVIDIA, AMD, all the silicon. But now it feels like the smart money is looking at the plumbing, the infrastructure.
Right, and looking at the chart for Applied Digital, it feels like the market hasn't just shifted its gaze, it's staring uncomfortably hard. I mean, let's just look at the price action. Mid-2024, this stock was what, $6, maybe $7?
Dead money, basically. Yeah.
And now here we are sitting in the mid-30s. That is a massive, almost vertical run-up.
It is. It's a breakout in every sense of the word.
But, and I have to be the wet blanket here, when I see a chart like that, my alarm bells start ringing. Is this just hype? Is this just people chasing anything with digital or AI in the name because they feel like they missed the boat on NVIDIA?
Or is there actually a real business here that justifies a 500% move?
That is exactly the right skepticism to have. Usually when a small cap stock rips like this, it's vaporware. But in this case, the fundamentals are actually chasing the stock price. To get it, you really have to understand the physical problem the AI industry is facing right now.
The physical problem.
Yes. We all know AI chips are powerful, but what we tend to forget is that they are essentially glorified space heaters.
Right, they run hot.
They don't just run hot, they generate a heat density that's comparable to a nuclear reactor core, just on a tiny scale. So if you take a modern H100 or one of the new Blackwell chips and you try to plug it into a standard, garden variety data center.
The kind from 10 years ago.
Exactly, the kind built for email servers. You don't get AI, you get an electrical fire.
Okay, so the existing infrastructure literally cannot handle the load. It melts. The old stuff just melts. And this creates a huge bottleneck. Everybody went out and bought the chips, but now they have nowhere to plug them in. This is the niche we call high-performance computing, or HPC. And this is exactly where Applied Digital has planted its flag. They don't build data centers. They call them AI factories.
AI factories, I have to admit, that is a sexy marketing term, but is it just a fresh coat of paint on a warehouse?
No, it's fundamentally different. Think of it like the difference between, say, a parking garage and a Formula One pit lane. A parking garage just needs concrete and some painted lines. An AI factory needs liquid cooling loops, massive power density per rack, and specialized engineering just to keep the equipment from frying itself. Applied Digital builds the pit lanes.
So they're the landlords for the super hot, power-hungry brains of the internet.
That's a great way to put it. And that specific position is what led to the financial results that just dropped for fiscal Q2 2026.
Yeah, let's get into the numbers, because this is where the rubber meets the road. They reported revenue of $126.6 million for the quarter, and that is up 250% year over year.
It's a staggering growth rate, just staggering.
250% is huge, but I want to drill down into that number because when I looked at the breakdown, something really caught my eye, and I'm not sure I like it.
Move on.
So, of that $126 million, about $85 million came from the HPC hosting side of the business. That's the growth engine, right?
Correct.
But inside that $85 million, they list $73 million as tenant fit-out services.
Yes, the fit-out revenue.
Fit-out services, to me, that sounds like construction work. It sounds like they're getting paid one-time fees to bolt racks to the floor and install cabling. That's not high-margin recurring software revenue. So why is the market valuing this like a tech darling if most of their growth this quarter was basically contracting work?
You are absolutely right to flag that. It is lower margin, and yes, technically it is non-recurring. Once the building is fitted out, that revenue stream is gone.
Exactly. So isn't that 250% growth number a bit of a mirage?
If you only look at the accounting, maybe. But you have to look at the strategic implication. Why would a tenant pay $73 million up front just to fit out a building?
Well, I assume because they want the space exactly how they want it.
It's more than that. It's a hostage fee. It's a commitment. When a hyperscaler, and we're talking about the biggest tech companies in the world here, writes a check for $73 million just to prepare the room, they aren't going to lease it for 6 months and then just leave. That upfront payment, it locks in the 10-year rental contract that follows.
So it's the down payment on all the future recurring revenue.
Exactly. It validates the demand. It proves that these customers are so desperate for capacity that they're willing to fund the construction themselves. So while the fit-out money is one time, it is the leading indicator for the high-margin rental income that's coming right behind it.
Okay, that makes more sense. It's a signal of customer stickiness.
And we are already seeing some of that rental income start to trickle in. They recognized about $12 million from the fully energized facility at Polaris Forge 1.
Polaris Forge. They really do like their sci-fi names, don't they?
They do. And, don't forget the legacy business. The boring, traditional data center hosting brought in about $41.6 million. That's up 15%. It's not the rocket fuel, but it keeps the lights on.
And are these facilities actually full, or are they just building ghost towns?
Oh, they're full. Jamestown and Ellendale in North Dakota, that's 106 megawatts and 180 megawatts, respectively. They're at full capacity, totally sold out.
Being sold out is a good problem to have, usually. But that brings me to the ugly part of the income statement. We talked about revenue, but what about profit? Because building these AI factories has to cost a fortune.
It's incredibly capital intensive, and yes, if you look at the bottom line, they are still posting a net loss.
A loss of $31.2 million for the quarter. That's about 11 cents a share.
Correct.
So if I'm playing devil's advocate, they are burning through $30 million every 3 months. Why shouldn't I be worried they're just going to run out of cash?
In a vacuum, losing $30 million looks bad. But in growth investing, the trend is your friend. You have to look at the direction of travel. That net loss, it narrowed by 76% compared to last year.
Okay, so they're losing less money while making a lot more money.
Significantly less. They're sprinting a marathon, revenue's up 250%, but they cut their losses by 3/4. That shows massive discipline. And if you look at adjusted EBITDA.
Which is basically their operational cash flow before all the accountants get involved?
Right. It flipped positive. A positive $20.2 million in EBITDA compared to just $6 million last year.
So the core business model actually works.
Yes. This is what we call operational leverage.
Yeah.
They've covered their fixed costs. So now, every new dollar of revenue flows much more efficiently to the bottom line. They're right at that inflection point where the cash machine really starts to turn on.
All right, I'll grant you the financials are improving. But I want to zoom out to the competitive landscape, because this is the part that always scares me with these small caps. You've got Amazon, Microsoft, Google. They have infinite money, armies of engineers. Why don't they just crush Applied Digital? Why does this company even exist?
That is the billion-dollar question. What is the moat? Why hasn't Bezos just eaten their lunch?
Exactly.
Well, it comes down to two things: niche technology and speed. Let's talk tech first. Applied Digital is banking heavily on a proprietary, waterless cooling technology.
Waterless cooling. Okay, explain that to me like I'm 5. Why does it matter if they use water or not? Is that just a green sustainability thing?
It's definitely a sustainability play, but that's not why it's a competitive advantage. The advantage is permitting.
Permitting.
Think about it. Traditional data centers use these massive cooling towers that evaporate millions of gallons of water. If you try to build one of those in Arizona or parts of California or even parts of Europe right now, the local government will laugh you out of the room. There just isn't enough water.
Right. Water scarcity is a huge issue.
By using a closed-loop, waterless system, Applied Digital can go to a municipality and say, "We won't touch your water table." That means they can get approved in places where Amazon or Microsoft might get rejected.
So the technology lets them build where others can't.
Exactly. It expands their total addressable map.
Okay, that's the tech. You also mentioned speed.
This is their Polaris Forge model. The hyperscalers, Google, Microsoft, they tend to build these bespoke, cathedral-like data centers, they're masterpieces, but they take 3, maybe 4 years to plan and build. Applied Digital uses a modular standardized design.
Like a prefabricated kit.
In a sense, they can deploy capacity much, much faster. In this AI race, time is the only variable that matters. If you have the chips today, you need the rack space today. You can't wait 3 years for a building.
So they're the speedboat leaving through the harbor while the ocean liners are still trying to turn around.
That's the perfect analogy. And the industry is noticing. They just won Best Data Center in the Americas 2025 from Data Cloud.
Which I assume is kind of like the Oscars for server farms.
It is. And it matters because it's peer validation. It tells the market, hey, this waterless stuff, it actually works.
Okay, so they have the tech, they have the speed, they have the revenue growth. Let's look at the stock itself. We talked about that run up to the mid-$30. Breakouts like this can be fragile. What's the sentiment out there?
It feels like we're at a sensitive juncture, but the sentiment has definitely shifted. For a long time, the narrative was fear. Can they finance this? Is it just a bubble?
And now?
Now the narrative is overhang removed.
Overhang removed. What was the specific overhang?
Mostly doubts about power availability. I mean, you can build a building, but can you get the utility company to give you the juice? And recently, there's been a lot of confirmed buzz that they've secured 600 megawatts of capacity.
Yes, 100 megawatts.
Yeah,
That's like a small city.
it's massive. And
Yeah.
securing that power is, frankly, harder than building the facility.
Yeah.
So the market looks at that 600 milli-UW number and says, okay, the runway is clear.
So if I'm an investor looking at this today, clearly the easy money has been made. The stock is up 500%. What's the next leg up? What am I watching for in the next, say, 3 months?
The catalyst calendar is pretty packed. First up, you have the fiscal Q3 earnings in April.
That's the big test.
It is. The market now expects perfection. They need to show that that 250% growth is continuing. If they miss, or if that fit-out revenue drops off without the rental income replacing it, the stock could get punished pretty hard.
High expectations are a dangerous thing.
Always. Then you have the expansion rumors. The rumor mill is suggesting they're targeting 900 megawatts of capacity soon. If they announce a deal that confirms 900 milli-UW, that re-rates the stock again.
But there's another rumor in the notes here that I find really interesting. It's a bit technical, but I think it could be crucial. The REIT conversion.
Ah, yes. The speculative golden goose.
For our listeners who aren't tax attorneys, can you explain why turning this tech company into a real estate investment trust, a REIT, would matter so much?
Okay, so on the surface, a REIT structure is about taxes. REITs don't pay corporate income tax as long as they distribute, like 90% of their taxable income to shareholders as dividends.
Which is nice.
It's nice, but that's not the real reason investors are excited. The real reason is who can buy the stock.
Explain that.
Right now, Applied Digital is a volatile, high-growth, small-cap tech stock. It's risky. So who buys that? Hedge funds, retail traders, growth funds.
Cowboys.
Cowboys. But who buys REITs? Pension funds, sovereign wealth funds, income funds, the widows and orphans money. We're talking trillions of dollars of capital that literally cannot buy Applied Digital right now because it doesn't fit their mandate.
I see. So if they convert to a REIT, they suddenly open the door to this massive wall of institutional money that is desperate for stable assets.
Exactly. And REITs usually trade at different valuation multiples. If they can show a path to $1 billion in net operating income, which is the target being whispered about, and they wrap that in a REIT structure, the stock price likely has to go up just to accommodate all that demand from the big funds.
That would be a game changer. That transforms it from a trade into an investment.
Correct. But we have to remember, it is just a rumor for now.
Okay, we've been pretty bullish here. We've talked about the growth, the cooling, the REIT potential. But we're smart wealth, not reckless wealth. I need you to take the other side. Why does this go to zero? Or at least, why does it get cut in half? What is the bear case?
You definitely shouldn't put your life savings into any single high-growth stock, and here is exactly why. First, cash burn.
We mentioned they're losing less, but they're still spending like crazy.
The cost of revenue rose 344% to over $100 million. Concrete, steel, copper, chips, it all costs a fortune. If the capital markets freeze up and they can't borrow money, construction just stops, period.
And to get that money, they usually sell more stock.
And that's risk number 2, dilution. To pay for these factories, they've historically issued more shares. Every time they do that, your slice of the pie gets a little bit smaller. As an investor, you're constantly fighting against that dilution.
You're swimming upstream.
And finally, there's execution risk. It is one thing to run a 100-megawatt facility in North Dakota. It's a completely different beast to scale to 600 or 900 megawatts across multiple sites. Things break, logistics get messy, and energy costs are rising. They saw a $3.2 million increase in energy costs just year over year.
Right. Their whole business is an arbitrage. They buy power and they sell compute. If the price of power spikes, their margin gets squeezed.
Exactly. If there's an energy crisis or if regulations change on power usage, Applied Digital is right in the crosshairs.
So it's a high beta play. If the whole AI narrative cracks, this stock probably falls faster and harder than Microsoft or NVIDIA.
Oh, absolutely. It'll be the first to fall.
All right, let's bring it all home. We've looked at the massive growth, the proprietary tech, the rumors of a REIT conversion, and the very real risks of cash burn and execution. What's the final verdict? How does this stack up as a wealth-building play right now?
If I had to give it a bullish score, I'm putting it at an 8 out of 10.
An 8 out of 10, even with the dilution risk.
Even with the risk. Here's the elevator pitch. This is a premier AI infrastructure play. You have 250% revenue growth. You have a proprietary technical moat with the waterless cooling that solves a real-world problem, and you have a clear path to massive capacity expansion.
It checks all the boxes for a market leader in a new category.
It does. The trade-off is the volatility. You have to accept that the stock might swing 10% in a single day. You have to accept the current losses, but you're exchanging that short-term pain for multi-year growth potential in what is the most important sector of the economy.
The AI build-out.
The overhang is removed. If you believe the AI boom is going to continue for the next few years, you need to own the roads and bridges, not just the cars. Applied Digital is building the bridges.
It's going to be a wild few months watching to see if they can actually execute on that 900 megawatt target.
Absolutely. Keep a very close eye on that April earnings report. That's going to be the truth serum.
We certainly will. That's the breakdown on Applied Digital.
Thanks for listening.
Thanks for listening to Smart Wealth with Joshua. Don't forget to like and subscribe.